Hey there, curious minds. Welcome back to The Deep Dive, your shortcut to being genuinely well-informed. Today, we're taking a deep dive into something that touches every single one of our wallets. Gross income. But trust me, it's far more than just your paycheck. We're going to uncover what the tax authorities truly consider income and some surprising things they don't to help you feel completely clued in.
That's right. Our mission for this deep dive is to, well, untangle those complex tax concepts, cut through all that confusing jargon,
Yeah.
and reveal the often surprising truth about what genuinely counts as income. By the end, you should feel much more confident about your own financial picture and how income fits into it.
Okay, let's unpack this right from the top. When you're figuring out your tax liability, what's the absolute first, most fundamental step? It all starts with gross income.
Mhm.
At its core, the definition is incredibly broad. It's all income from whatever source derived, unless specifically excluded.
Mhm.
And this is where it starts to get really interesting because that whatever source part is huge.
It really is.
Yeah.
What's fascinating here is just how expansive that definition truly is.
Hmm.
It's not limited to what you traditionally earn.
Hmm.
Think about this. If you were to find, say, $4,000 hidden under a floorboard in your house, and you genuinely couldn't find the original owner, and you
Yeah.
decided to keep that money,
Yeah.
that $4,000, despite not being earned in the sense of a job, is still considered income for tax purposes.
Wow. That's a huge aha moment for a lot of people, I bet. It fundamentally shifts how we should think about what the IRS considers income, doesn't it?
Absolutely.
It's not just about a salary or business profit, but any increase in your wealth that you have control over.
Precisely. It highlights that the source isn't the primary concern, but rather the gain itself.
And it's not just cash either. Income is determined by the amount of cash or the fair market value of property or even services you obtain. To put a fine point on it, imagine you're a web designer, right? And instead of getting paid cash for a new website, a client gives you a classic car as compensation. If that car has a fair market value of $3,000, then that entire $3,000 is income to you, even though you never saw a dollar bill from that client.
Exactly. And building on that, the fundamental concepts of realization and recognition are absolutely crucial to understand here.
Realization and recognition. Okay.
Yeah. Realization means that you've actually accrued or received cash, property, or services. Or it could be a change in the form of an investment, like when you sell something or exchange it. For instance, if you own stock that you bought for $100 and its value goes up to $150,
Mm-hmm.
your wealth has definitely increased on paper, but you haven't realized that gain yet.
So realized is like potential income, but it's not actually taxable until it's recognized, right?
Precisely. Recognition means that once a gain is realized, once that change has occurred, like the sale, it must be included on your tax return.
Yeah.
Assuming there isn't a specific rule in the tax law that allows you to simply exclude it or push it to a later year. So this distinction truly matters because it's the difference between merely having more wealth on paper and actually having taxable income that needs to be reported to the IRS.
Got it. So what does this all mean for when income actually hits the tax books? How is the timing decided?
Well, it depends on the accounting method you use. There are two main ways to time that income recognition.
Okay.
First, there's the accrual method. With accrual, revenue is generally taxable when it's earned. This typically follows what we call GAAP principles.
Generally accepted accounting principles,
Right.
often used by larger businesses.
Exactly. Then there's the cash method, which is often simpler, especially for individuals and smaller businesses. Under this method, revenue is taxable in the period you actually or constructively receive it. Cash or, like your example, the fair market value of property.
Constructively received. What does that mean exactly?
Good question. It means you have access to it, even if it's not physically in your hand yet. For example, if your paycheck is available for you to pick up on December 31st, but you wait until January 1st to actually get it. For tax purposes, you constructively received it in December because it was available to you then.
Wow, that's a great practical point. Okay, now beyond your base salary, there's a whole world of compensation and benefits. What falls under the taxable umbrella that might surprise people, or maybe things they just take for granted?
Well, the obvious one is money, right? All money you receive, get credited with, or that's simply available to you through that constructive receipt we just mentioned, that's taxable.
Right.
And the fair market value, the FMV, of all property you receive as compensation is also included in your gross income.
And here's one many people overlook. Bargain purchases. If your employer sells you property for less than its fair market value, That difference, that discount, essentially.
Is income to you. Yep.
Okay.
Also, if you're a partner in a business, any guaranteed payments you receive for your services or capital contributions are considered earned compensation. And these are generally subject to self-employment tax. We can touch on that more later.
Okay. What about, like, company perks? Fringe
Mm.
benefits?
Ah, yes. It's important to remember that many fringe benefits, if they're not specifically excluded by tax law, are indeed taxable. For example, your personal use of a company car, that's generally treated as taxable wages and is subject to employment taxes.
Got it.
And if you choose to have your employer contribute to a Roth 401k account, those employer contributions are included in your income right away.
Which is different from a traditional 401k, where the employer contribution usually isn't taxed up front.
Exactly. And another interesting one, group term life insurance, if your employer pays for it.
Yeah.
Premiums for coverage above a certain threshold, currently it's $50,000 per employee, are taxable. It's calculated from an IRS table, not the full excess premium, so it's a specific calculation, but it's something to be aware of.
It's good to know.
So this raises an important question. What about those valuable perks and benefits that, surprisingly, aren't taxable under specific conditions?
Ah, the good stuff.
Exactly. These are the real gems that can make a difference in your financial picture. For instance, that life insurance we just mentioned. The value of premiums your employer pays on your behalf for up to that $50,000 of group term coverage is generally excludable, not taxed.
Okay, so the first $50 is tax-free.
Right. The same goes for employer-paid accident, medical, and health insurance premiums. That's a huge benefit that typically isn't taxed to you when the premium is paid.
That's significant. It means your employer can help you cover major costs without adding to your immediate tax bill.
Precisely. Then there are what we call de minimis fringe benefits.
De minimis.
Yeah, it just means they're so minimal in value that it's just impractical to account for them. Think employees' occasional personal use of a company copier or maybe office snacks.
Right, small stuff.
Small stuff. These are typically excluded. Also, meals and lodging provided by your employer can be excluded under certain conditions. They have to be furnished right there on the business premises for the convenience of the employer, and for lodging, it has to be a required condition of your employment.
Okay, so not just any free lunch. Specific circumstances.
Very specific. And there's more. Your employer can even pay up to a certain amount of your educational expenses each year.
Oh, really?
Yeah, including student loan payments now, and you might be able to exclude that from your gross income. It applies to both undergrad and grad studies. The limit for 2023 was $5,250.
Wow, that's a nice perk.
It is. And if your employer offers an employee adoption assistance program, you might be able to exclude a significant amount of qualified adoption expenses. For 2023, it was up to $15,950, though this benefit does phase out at higher income levels.
Good to know.
Similarly, up to a certain amount, $5,000, I believe, of dependent care assistance benefits or reimbursements from an employer can be excluded. Even qualified tuition reductions for employees of educational institutions can be excluded, especially for undergraduate studies, or for grad students doing teaching or research if certain conditions are met.
That's a lot of ways employers can structure benefits to be tax-friendly.
Definitely. Let's not forget qualified employee discounts. Those are excludable up to the employer's gross profit percentage for merchandise or 20% of the fair market value for services.
Okay.
And something often appreciated in cities, employer-provided parking or transit passes. Up to a certain monthly limit, currently $300 for 2023, can be excluded, even if you could have chosen cash instead.
That's useful.
And for retirement planning, contributions made by your employer or even your own pre-tax contributions to qualified non-Roth retirement plans are generally not income at the time of contribution.
Right, you pay tax later when you take the money out.
Correct. And for flexible spending arrangements, FSAs, those pre-tax deposits into your employee account each year up to the limit aren't taxed when deposited.
But you generally have to use those or lose them, right?
Mostly, yes. There's usually a grace period of maybe 2.5 months after year end, or some plans now allow a small carryover amount. For 2023, that carryover was up to $610. Otherwise, yeah, use it or lose it.
Okay, here's where it gets really interesting. Understanding these specific exclusions can make a significant difference in your overall financial planning. It's not just about what you earn, but how those earnings and benefits are structured that impacts your tax bill.
Absolutely critical.
All right, let's pivot to money, interest, and dividends. What's the tax story there, and where can you catch a break?
Okay, interest income. Generally, interest from things like federal bonds, most corporate bonds, part of installment sale proceeds, That's usually taxable.
Even interest on a late tax refund from the government.
Yep, that's taxable too.
Huh. Okay. But there are exceptions, right? Tax-exempt interest.
Yes, and this is valuable. There's a category of tax-exempt interest that, while you still have to report it on your return, isn't actually taxed. This primarily includes interest from state and local government bonds or obligations. Think municipal bonds.
Muni bonds, right.
Also bonds of U.S. possessions like Guam or Puerto Rico, and interest from U.S. Series EE savings bonds issued after 1989, if it's used for qualified higher education expenses and you meet certain conditions, age, income phase-outs, things like that. But it can be a great tax-free way to save for college.
Good to know about the EE bonds. Now, here's a quirky one I've heard about. Forfeited interest, like from a CD.
Ah, yes. If you withdraw money early from, say, a certificate of deposit and you incur a penalty,
Mm-hmm.
the bank might report the full interest earned as income to you on a 1099 INT. That interest received is technically taxable, but the amount you forfeited as a penalty is deductible as an adjustment to your income in the year you incur it.
So you don't actually pay tax on the interest you lost.
Correct. You net it out, essentially,
Right.
but through two separate lines on the tax form income and an adjustment. It's not netted directly against the interest income itself.
Okay, slightly complicated, but gets you to the right place. Now let's talk dividends. What makes a dividend taxable?
Okay, dividends. A dividend is essentially a distribution from a C corporation out of its earnings and profits. Remember, a C corp is taxed separately from owners.
Right.
So the taxability depends on whether the corporation has earnings and profits, either current or accumulated from prior years.
Ugh.
If it does have earnings and profits, then the distribution is a taxable dividend.
What if it doesn't?
Good question. If there are no earnings and profits, but you still have basis in your stock, meaning your investment cost,
Yeah.
then the distribution is considered a non-taxable return of capital. It just reduces your stock basis.
Okay, so you get your own money back, essentially, tax-free.
Right. But if there are no earnings and profits and you have no stock basis left, maybe you already got previous returns of capital,
Then what?
then it's actually taxed as a capital gain.
Interesting. Okay. And how much is taxed? If it's cash, it's the cash amount?
Yep, cash received is the taxable amount.
Mm-hmm.
If they distribute property instead of cash, then it's the fair market value of that property that's taxable.
Now, I've heard about qualified dividends having lower tax rates. What's that about?
Yes, that's a big one. Qualified dividends get preferential tax treatment. They're taxed at the same lower rates as long-term capital gains.
0%, 15%, or 20%, depending on your overall taxable income?
Exactly, which can be much lower than ordinary income rates.
So what makes a dividend qualified?
Well, generally, they have to be paid by domestic corporations or certain qualified foreign corporations, and you need to meet a holding period requirement for the stock. You typically need to hold the stock for more than 60 days during a specific 120-day period that starts 60 days before the ex-dividend date.
The ex-dividend date, that's the cutoff date for receiving the dividend, right?
Right. If you buy on or after that date, you don't get that particular dividend. So the holding period is key.
Are there dividends that don't qualify?
Oh, yes. Things like dividends from credit unions, mutual savings banks, certain tax-exempt organizations, dividends paid on employee stock ownership plans, or ESOPs. Those generally don't qualify for the lower rates.
Okay. And just to be clear, not all distributions from a company are taxable dividends, right?
Correct. We mentioned return of capital that's tax-free, reduces basis. A stock split is also generally tax-free. You just allocate your original cost basis over more shares. A stock dividend, getting more shares instead of cash, is usually tax-free too, unless you have the option to take cash instead. If you just get stock, you allocate your basis. And life insurance dividends, often paid by mutual insurance companies, are usually considered a tax-free return of premium.
Got it. Lots of nuances there.
Absolutely. And if we connect this to the bigger picture, retirement planning and annuities are prime examples of where understanding these income tax rules can significantly impact your financial future.
Okay, let's dive into retirement accounts. IRAs first. Traditional versus Roth.
Right. Let's start with traditional IRAs.
Hmm.
The key here is whether you deducted your contributions when you made them. If you did take a deduction, then distributions of that principal later on are taxable.
Makes sense. You got the tax break up front.
Exactly. Distributions of the earnings in a traditional IRA are always taxable, regardless of whether the contributions were deductible or not.
Okay. What if you made non-deductible contributions?
Good point. If you have a mix of deductible and non-deductible contributions in your traditional IRAs, then any distribution is allocated pro rata proportionally between the non-taxable principal. from non-deductible contributions, and taxable amounts, deductible contributions plus all earnings.
So you need good records.
Definitely need good records for non-deductible contributions. And don't forget, required minimum distributions, RMDs. They generally start by April 1st of the year after you reach age 73.
Okay, now Roth IRAs. They work differently, right? Often seem more favorable in retirement.
They often are because of how distributions are taxed. With Roth IRA, distributions of your principal, your original contributions, are never taxable.
Because you put in after-tax money.
Correct. You pay tax already.
Yeah.
Distributions of the earnings from a Roth IRA are taxable only if it's considered a non-qualified distribution.
Ah, so the goal is a qualified distribution. What makes it qualified?
Two main conditions for qualified distributions, where both principal A&D earnings are tax-free. First, the distribution must be made at least 5 years after your very first contribution to any Roth IRA. It's a 5-year clock that starts ticking early.
Okay, 5 years. And the second condition?
And second, you generally need to meet one of these.
Mm-hmm.
You're age 59 and a half or older, you're disabled, you're using it for a first-time home purchase, up to $10,000 lifetime max, or the distribution is made after your death to a beneficiary.
Got it. 59 and a half and 5 years are the big ones for retirement.
Usually, yes. And here's a helpful rule. Roth IRA distributions are considered to come first from your non-taxable principal and then from any taxable earnings.
That's great. So you get your tax-free money out first.
Exactly. Let's use a quick example. Imagine Sally opened an IRA at 55, contributed $5,000. Years later, the account is worth $8,000. She withdraws $6,000.
Okay.
Scenario 1. Traditional IRA, she deducted the contribution. The whole $6,000 is taxable ordinary income. Scenario 2. Traditional IRA, she didn't deduct the contribution. Part of the 6K is return of non-deductible basis, tax-free. Part is earnings, taxable. It's that pro rata calculation.
Oh, okay.
Scenario 3, Roth IRA, withdrawn just 4 years after contribution, non-qualified. Her $5,000 contribution comes out tax-free. The other $1,000 represents earnings, and that $1,000 is taxable.
Better, but still some tax.
Scenario 4, Roth IRA, withdrawn 6 years after contribution, and Sally is now, say, 60. It's qualified. The full $6,000 is tax-free, $0 taxable income.
That Sally example really highlights the difference. That Roth advantage in retirement is clear.
It can be huge. Now, generally, if you take money out of an IRA before age 59 and a half, there's usually a 10% penalty tax.
On top of the regular income tax, if any?
Correct. However, there are several important exceptions to that 10% penalty, even if the distribution itself is still subject to ordinary income tax. Things like using it for a first-time home purchase, up to $10, paying medical insurance premiums while unemployed, unreimbursed medical expenses that exceed a certain percentage of your AGI.
AGI being adjusted gross income.
Right. Also, permanent disability, qualified education expenses, adoption or birth of child, up to $5, certain disaster relief, or distributions after death or due to terminal illness.
So there are ways around the penalty in emergencies or for specific life events.
Yes, but the regular income tax might still apply, especially for traditional IRAs.
What about converting a traditional IRA to a Roth IRA?
Good question. When you convert, the amount you move from the traditional to the Roth is generally taxed as if it were a distribution in the year of conversion. So any pre-tax contributions and all the earnings you convert become taxable ordinary income.
But no 10% penalty.
Generally, no 10% early withdrawal penalty applies to the conversion itself, as long as you complete the rollover properly, usually within 60 days if you take the money out first.
Okay. Let's shift gears slightly to annuities. How is income from those taxed?
Annuities are interesting. When you start receiving payments, each payment typically consists of two parts: a non-taxable return of your original investment, your contributions or cost basis, and taxable earnings.
So part tax-free, part taxable. How do you figure out the split?
It depends on the type of annuity payout. For a fixed period annuity, where payments last for a set number of years,
Yeah.
you use an exclusion ratio. You calculate your original investment divided by the total expected value of all the payments. That percentage is the tax-free portion of each payment.
Okay, give me an example.
Sure. Let's say Zoe bought an annuity for $60,000. It will pay her $750 per month for 120 months. That's 10 years.
Okay.
The total expected payout is $750 times 120 months, which is $90,000. Her exclusion ratio is her investment, $60,000, divided by the expected return, $90,000, which is 66.7%.
So 2/3 is tax-free.
Exactly. 66.7% of each $750 payment is the non-taxable return of her capital. The remaining 33.3%, about $250, is taxable income.
Makes sense. What about a life annuity where payments continue for your whole life? You don't know the total payout.
Right. For life annuities, since the payment period is unknown, you use IRS life expectancy tables. You take your original investment and divide it by a life expectancy factor from the IRS tables, based on your age when payments start. This gives you the non-taxable amount per month, or year, depending on the factor.
Okay, example, Sam, again.
Let's say John, age 64, buys an annuity for $60,000 that pays him $600 a month for life. We look up the IRS factor for age 64. Let's say it's 260 months.
Okay.
His non-taxable return of capital per payment is $60,000 divided by 260, which comes out to about $231 per month. So of his $600 monthly payment, $231 is tax-free return of capital, and the rest, about $369, is taxable income.
What happens if John lives longer than the 260 months the IRS estimated?
Good point. Once he's recovered his entire $60,000 investment tax-free, which would happen after 260 payments in this example, any further payments he receives are fully taxable.
And if he dies sooner, before getting his $60,000 back?
If he dies before recovering his full investment, the remaining unrecovered investment amount can usually be deducted on his final income tax return.
Okay, that seems fair. Wow, that was a deep dive into savings and investments. Knowing these nuances is crucial for smart financial planning, especially for retirement.
Absolutely. Planning ahead makes a huge difference.
All right, many of us wear different hats, maybe a side hustle, maybe renting out property. How does the tax code view these activities? What's deductible? Let's start with running your own business as a sole proprietor. Schedule C, right?
That's right. Schedule C on your Form 1040. Your growth income for the business includes your normal revenue cash, fair market value of property received, even cancellation of debt related to the business.
Okay, and what about expenses? What can you deduct?
A lot of the usual suspects. Cost of goods sold, if you sell products, salaries and commissions you pay to employees, not yourself, state and local business taxes paid, office expenses, supplies. You can deduct car expenses, either the actual costs allocated to business use or the standard mileage rate, which changes yearly. Business meal expenses are usually 50% deductible.
Depreciation on business assets.
Yes, depreciation is a key deduction. Also, employee benefit program costs, legal and professional fees, bad debts actually written off if you use the accrual method.
What about interest on business loans?
Generally deductible, yes, but there's limitation for larger businesses based on a percentage of your adjusted taxable income plus business interest income. Smaller businesses, those under a certain average gross receipts threshold, usually aren't subject to this limit.
Got it. Now, just as important, what can't you deduct on Schedule C?
Good question. You can't deduct salary paid to yourself as the sole proprietor that's considered an owner's draw or withdrawal, not an expense.
Right.
Federal income tax is never deductible. The personal portion of things like car use, travel, meals, only the business part is deductible. Personal interest or personal state and local taxes don't go on Schedule C. They might be itemized deductions on Schedule A if you itemize.
What about health insurance for the sole proprietor?
That's an adjustment to income on the front page of your 1040, not a Schedule C expense. It reduces your adjusted gross income. Also, bad debts. If you're a cash basis taxpayer, you can't deduct debt. You were never paid if you never recorded it as income in the first place.
Makes sense. Charitable contributions, entertainment.
Charitable contributions are typically an itemized deduction on Schedule A, and entertainment expenses are generally not deductible anymore.
Okay. So after all that, if you have net business income on Schedule C, what taxes do you owe?
It's subject to two main taxes: regular income tax based on your overall tax bracket, and D, self-employment tax.
Ah, the SE tax. That covers Social Security and Medicare, right?
Exactly. It's basically the employer and employee halves combined. For 2023, it was 12.4% for Social Security up to an income cap, $160,200, plus 2.9% for Medicare on all net earnings from self-employment. Total, 15.3% on most of it.
That's significant.
It is. The tax is calculated on 92.35% of your net self-employment earnings. The good news is you get to deduct 1/2 of the SE tax you pay as an adjustment to income.
Okay, a small break there. Can you give a quick example?
Sure. If Tyler earns $20,000 net income from his consulting business, first find the base. $20,000 times 92.35% is $18,470. Then the SE tax is 15.3% of that $18,470, which is about $2,826. That's in addition to his regular income tax on the $20,000.
Got it. What if the business has a net loss?
A net business loss from Schedule C is generally deductible against your other income, like wages or investment income. However, there are limitations. There's an overall excess business loss limitations we'll discuss, and rules around net operating losses, NOLs.
Okay. Now, what about hobbies? If it's not really a business run for profit.
Hobby losses.
Huh.
The IRS has rules to distinguish between a business run with a profit motive and a hobby done primarily for personal pleasure.
Hmm.
They look at several factors. Do you run it in a business-like manner? Keep good records? Do you have expertise? Spend significant time and effort? Expect assets to appreciate? Things like that.
Is there a rule of thumb?
There's a 3 to 5 year presumption. If the activity shows a profit in at least 3 out of the last 5 consecutive years, the IRS presumes it's a business, not a hobby. The burden shifts to them to prove otherwise.
What if it is deemed a hobby?
If it's a hobby, you must still include all the revenue you receive from it in your gross income, usually under other income.
Hmm.
But, and this is key, you generally cannot deduct any expenses related to the hobby. Those deductions were eliminated for most people a few years ago.
Ouch. So income is taxable, but expenses aren't deductible.
Pretty much for a hobby. So this raises an important question. What about rental properties? From vacation homes to pure investments, the rules here can be surprisingly specific.
Yeah, let's get into rentals. Schedule E, right?
Usually, yes. Schedule E is for supplemental income and loss, including rentals. The basic formula is simple. Gross rental income minus rental expenses equals net rental income or loss. Gross rental income includes rent received, obviously, but also things like prepaid rent, taxable when received, payments a tenant makes to cancel a lease, or even the value of improvements a tenant makes instead of paying rent.
Okay. Now, what about renting out your own home, like a vacation home?
That's where it gets tricky. Depends on how much you rent it versus how much you use it personally. Rule 1. Rent it fewer than 15 days a year. If you rent it out for less than 15 days total during the year,
Yeah.
treat it as your personal residence. The great part, you don't have to report any of the rental income. It's excluded.
Nice. Downside.
Your expenses directly related to the rental, like cleaning or commissions, aren't deductible. Your mortgage interest and property taxes are still potentially deductible as itemized deductions, just like for your main home, but nothing else like depreciation or utilities related to those few rental days.
Okay. Less than 15 days equals income excluded, no rental expense deductions. What if you rent it for 15 days or more?
Now, it depends on your personal use. If you rent it 15 plus days A&D, you also use it personally for more than 14 days or are more than 10% of the total days it was rented, whichever is greater.
Okay, significant personal use.
Then it's considered a mixed-use property, a personal rental residence. You have to report the rental income, and you have to allocate expenses between personal use and rental use.
How do you allocate?
Mortgage interest and property taxes are usually allocated based on the number of rental days divided by the total days in the year. Other expenses like utilities, insurance, repairs, depreciation are allocated based on rental days divided by total days used, rental plus personal.
Complicated. And can you deduct all the allocated rental expenses?
Critically, no. Your deductible rental expenses are limited to the gross rental income received. You deduct them in a specific order. Interest taxes first, then operating expenses, then depreciation last. Often you can't deduct all the depreciation because you hit the income limit. Any disallowed loss, usually the unused depreciation, gets carried forward to future years.
Wow. Okay, let's use that Julie example from the outline. 6-year rental income, lots of expenses. Rented 60 days, used personally 30 days.
Right. So total use is 90 days. Rental use is 60/90 or 20/3. Personal use is third turned. Interest and taxes, $2,400 taxes, $3,600 interest equals $6,000 total allocated to rental. 20/3, $6,000 or $4,000. Other expenses, utilities, $4,800. Depreciation, $7,200 allocated to rental. 20/3, $12,000 yield $8,000. Now apply the limit. Gross rental income is $6,000. Deduct interest taxes first, $6,000, $4,000, $2,000 remaining income. Deduct operating expenses like utilities next. Rental utilities were $2,300, $4,800 equals $3,200, but we only have $2,000 income left. So deduct $2,000 of utilities. Income is now $0. The remaining $1,200 of utilities and all $4,800 of the allocated depreciation, $7,200, $23, are not deductible this year. They get carried forward.
So even though she had $8,000 in allocated rental expenses beyond interest taxes, she could only deduct $2,000 of them because of the income limit.
Exactly. It prevents creating a loss from renting out your vacation home.
Got it. What about a property that's purely rental, no personal use, a non-residence?
Much simpler. All rental income is included. All expenses allocated to the rental property are deductible. If this results in a rental loss, it's generally considered a passive activity loss.
Passive loss rules, meaning you can usually only deduct passive losses against passive income.
Generally, yes. Passive losses can't usually offset active income like wages or portfolio income like interest dividends. However, there's a significant exception for real estate rental losses. If you are an active participant in the rental activity.
Meaning you make management decisions, approve tenants, etc.
Right. If you actively participate, you might be able to deduct up to $25,000 of rental losses against your non-passive income each year. This $25,000 allowance phases out at higher income levels, though.
That 25K exception is a big help for many smaller landlords.
It really is.
Okay. And what about those more complex business structures like partnerships or S-corp? How does income flow through to you as an owner?
These are called flow-through entities. Partnerships, S-corporations, and LLCs that elect to be taxed is one of those. The key concept, as the name suggests, is that the income, gains, losses, deductions, credits, they all flow through the entity directly to the owner's individual tax returns, Form 1040.
So the business itself doesn't pay income tax.
Generally, no federal income tax at the entity level. The owners pay the tax at their individual rates. This avoids the potential double taxation you can get with a C corporation, where the corp pays tax and then shareholders pay tax again on dividends.
How does the owner know what flows through?
The entity files an information return, like Form 1065 for partnerships or 1120S for S-corp, and provides each owner with a Schedule K-1. The K-1 details the owner's share of the entity's ordinary business income or loss, plus any separately stated items.
Separately stated items, why separate?
Because these items might be treated differently on each owner's individual return depending on their personal tax situation. Examples include net rental real estate income loss, interest income, dividend income, capital gains and losses, charitable contributions, Section 179 expense deduction. Things like that need to retain their character.
Okay. What about payments to partners or S-corp owners for work they do?
Important difference here. A partnership can make guaranteed payments to a partner for services or for the use of capital. These guaranteed payments are deductible by the partnership, reducing ordinary income, but flow through as separately stated income to the partner. And critically, they are generally considered self-employment income to the partner, subject to SE tax.
Okay, partner gets guaranteed payment, it's SE income. What about an S-corp owner who works for the business?
An S-corp owner who performs services should receive a reasonable salary as an employee, W-2 wages. This salary is subject to regular payroll taxes, FICA, Social Security, Medicare, income tax withholding. The S-corp deducts the salary as a business expense.
So W-2 salary for the S-corp owner, not SE income on that part. What about the rest of the S-corp's profit allocated to them?
That's the key distinction. The partner's share of the partnership's ordinary business income, beyond guaranteed payments, is also generally subject to SE tax if the partner actively participates. But the S-corp shareholder's allocated share of the S-corp's ordinary business income, their K-1 share beyond their salary, is not subject to self-employment tax.
Ah, that sounds like a major reason to choose S-corp status. You pay payroll tax on the salary, but the remaining profit distribution isn't hit with SE tax.
It's a very common reason, yes. Saving that 15.3% SE tax on profit distributions can be significant. Of course, the salary paid must be reasonable for the services performed.
Right. Can't just pay yourself $1 salary and take millions in distributions. Okay, what about losses flowing through? Are there limits?
Yes, several layers of limitations can apply to deducting flow-through losses. First is the tax basis loss limitation. You can only deduct losses up to your tax basis in the entity. Your basis is generally your investment, plus your share of income, minus distributions and prior losses.
So if the loss is bigger than your basis, you can't deduct it all.
Correct. Any loss in excess of your basis is suspended and carried forward indefinitely. You can deduct it in a future year if and when you have sufficient basis again. If you sell your interest before using the suspended loss, it's generally lost.
Can you give an example of basis limitation like that Don Carson one?
Sure. Don starts the year with a $50,000 basis in his partnership. During the year, he receives $30,000 in distributions. His share of the partnership loss for the year is $25,000. First, distributions reduce basis. So $50 K basis, 30K distribution equals 20K basis before considering the loss. His share of the loss is $25,000. But his basis is only $20,000. So he can only deduct $20,000 of the loss this year. His basis is reduced to zero, 20K loss deducted. The remaining $5,000 of the loss, 25K total loss, 20K deducted, is suspended and carried forward.
Got it. Basis limits the loss deduction first. Is there another limit after that?
Yes. After applying basis and other limits like at-risk rules, which we didn't detail, there's the overall excess business loss limitation. This rule prevents non-corporate taxpayers, individuals, trusts, estates, from deducting an overall excess business loss against their non-business income.
How much is excess?
There's an index threshold.
Right.
For 2023, taxpayers could deduct net business losses exceeding $578,000 for married filing jointly, or $289,000 for all other taxpayers. This applies to the combined net losses from all your trades or businesses, sole props, farms, flow-throughs.
So even if you have basis, if your total business losses are huge, this could limit them.
Exactly. Let's use the Betsy Chaplin example. Single taxpayer, $600 portfolio income, $500 income from her sole proprietorship, but a $900,000 loss from a partnership she owns.
Okay.
Her combined business income loss is $500 income, $900 K loss yields a net business loss of $400,000. As a single taxpayer in 2023, her excess business loss threshold is $289,000. So even though her net business loss is $400,000, she can only deduct $289,000 of it against her $600,000 portfolio income this year.
What happens to the rest of the loss, the $111,000 difference?
That $111,000, $400K total loss, $289K allowed, is treated as an excess business loss and is carried forward to the next year as part of the net operating loss, NOL.
Wow, these limitations can definitely impact tax planning for business owners.
They absolutely can. Need to be aware of basis, at-risk, passive activity, and excess business loss rules.
Okay, income can pop up in all sorts of unexpected ways, too, from a tax refund to a lottery win. What should we know about these unique situations? Let's start with state tax refunds. Are they taxable?
Sometimes. It depends on whether you got a tax benefit from deducting those state taxes in the year you originally paid them. If you itemized your deductions in the prior year and deducted state and local taxes, SALT, then yes, the refund you receive the next year is generally taxable income, up to the amount of the tax benefit you received.
But what if you took the standard deduction in the prior year?
Then the state tax refund is generally not taxable because you didn't get a specific federal tax benefit from paying those state taxes in the first place.
Okay, that makes sense. It's called the tax benefit rule, like that Carlos example. He took the standard deduction in year 10, got a $150 state refund in year 11. That $150 is not taxable income in year 11.
Exactly. Now, payments related to a divorce also have very specific and recently changed rules. Let's talk alimony or spousal support.
Right. This changed a few years ago, didn't it?
Big change. The key is the date the divorce or separation agreement was executed. If the agreement was executed on or before December 31st, 2018, then the old rules apply. Alimony is included in the income of the recipient spouse and deductible as an adjustment to income by the payer spouse.
Okay, pre-2019 agreements. Taxable to recipient, deductible by payer. What about newer agreements?
If the agreement was executed after December 31st, 2018, or modified after that date to adopt the new rules, then alimony is not included in the recipient's income, and it cannot be deducted by the payer.
So no income, no deduction for post-2018 agreements. Huge shift.
Huge. And for payments to even qualify as alimony under either set of rules, they generally must meet certain requirements, legally required cash payments, and that pays death, not between members of the same household, not designated as something else like child support, and spouses can't file a joint return.
What about child support?
Child support is much simpler and didn't change. It is never taxable income to the recipient parent, and it's never deductible by the paying parent.
And if a payment includes both alimony and child support, but isn't enough to cover both?
The payment is applied first to child support. Only the remainder, if any, could potentially be considered alimony under the applicable pre- or post-2019 rules.
Okay. And property settlements in a divorce, like dividing up assets.
Generally non-taxable. When property is transferred between spouses as part of a divorce settlement, it's typically not a taxable event for either spouse. No income, no deduction. The recipient usually takes the property with the same basis the transferor had.
Got it. Moving on. Unemployment compensation, taxable.
Yes. Unemployment compensation is fully taxable and must be included in gross income. Sometimes federal taxes can be withheld, but whether they are or not, it's taxable income.
Okay. What about Social Security benefits? Are they taxed?
They might be, partially. It depends on your provisional income, which is basically your modified adjusted gross income, MAGI, plus half of your Social Security benefits.
MAGI, that's AGI, plus some add-backs like tax-exempt interest.
Generally, yes. Based on your provisional income level and filing status, anywhere from 0% up to 50%, or even up to 85% of your Social Security benefits could be included in your taxable gross income.
So higher income people might pay tax on a chunk of their Social Security.
Correct. For example, in 2023, for a single individual, if your provisional income was over $34,000, up to 85% of your benefits could be taxable. The thresholds are different for married couples.
Need to run the numbers on that one. And quickly, income in the year someone passes away.
Final income tax return, Form 1040, is filed for the decedent for the year of death. It includes all income earned or received up to the date of death, determined using their normal accounting method. Any income received after the date of death, like investment income paid to the estate, is generally reported on the estate's income tax return, Form 1041, not the decedent's final 1040.
Okay.
So we connect this to the bigger picture. It's clear that not everything that feels like income to you is taxable, and sometimes things you don't think of are. Let's cover some other miscellaneous items.
Good idea. What about prizes and awards, like winning the lottery or a game show?
Generally, yes. The fair market value, FMV, of prizes and awards is taxable income. Lottery winnings, game show prizes, employee awards for performance, usually taxable. There's a very narrow exception for certain awards for civic, artistic, scientific achievement, etc., but only if the recipient didn't seek the award and assigns it directly to a governmental unit or charity. Very rare.
Okay, assume prizes are taxable. Gambling.
Gambling winnings are fully included in gross income. You report all winnings. Gambling losses are deductible, but only as an itemized deduction on Schedule A, and crucially only up to the amount of your reported gambling winnings for the year. You can't deduct net gambling losses.
So if you win $1,000 and lose $1,500, you report $1,000 income and can deduct $1,000 in losses if you itemize, but the extra $500 loss does you no good.
Exactly right.
What about damages received from lawsuits?
Taxability depends entirely on what the damages were paid in lieu of what were they meant to replace. If it's compensation for lost business profits or wages, then yes, it's taxable income, just like the profits or wages would have been. But if the damages are for personal physical injury or physical sickness, they're generally non-taxable. Emotional distress damages are usually taxable unless they stem directly from a physical injury.
Okay, physical injury, non-taxable. What about punitive damages? Those extra amounts meant to punish the wrongdoer.
Punitive damages are almost always taxable as ordinary income. This applies whether they're received in a business context, like lost profits plus punitives, or for loss of personal reputation. Even punitive damages received in a personal physical injury case are generally taxable, with a very limited potential exception in some wrongful death cases depending on state law. So assume punitives are taxable.
Got it. Cancellation of debt or cut income. You mentioned this briefly before.
Yes. Generally, if a lender forgives or cancels debt you owe, the amount canceled is considered taxable income to you. Like that Mary example. She owes $80, settles for $30K. The bank forgives $50K. That $50K is taxable seed income to Mary.
Are there exceptions? When is canceled debt not income?
Yes, several important ones. Debt discharged in a bankruptcy proceeding is generally not income. Debt canceled when the taxpayer is insolvent, meaning their liabilities exceed the fair market value of their assets before the cancellation, is excluded, but only up to the amount of insolvency. Cancellation of certain student loans due to working in specific professions or meeting certain conditions might be excluded, especially under temporary rules for 2021-2025. Cancellation of qualified principal residence indebtedness was another past exclusion, but that expired.
Okay, so insolvency and bankruptcy are key exceptions.
Yes, and also for non-recourse debt, where the lender can only seize the collateral. If you forfeit the property securing a non-recourse loan and the debt exceeds the property's value, the excess debt cancellation isn't seed income. Instead, the whole transaction is treated as a sale of the property.
Complex area. What about scholarships?
Partially taxable, potentially. For a degree-seeking student, scholarship or fellowship amounts are excludable from income only up to the amount actually spent on qualified tuition, fees, books, and required supplies.
What's not covered by the exclusion?
Amounts used for room and board are generally taxable. Also, if the scholarship requires the student to perform services, like teaching or research, as a condition of receiving it, it's generally considered taxable compensation.
What about for non-degree students?
Scholarships or fellowships received by non-degree-seeking students are generally fully taxable at fair market value.
And tuition reductions for graduate assistants?
If the tuition reduction is their only compensation for teaching or research, it's taxable. But if it's in addition to other taxable compensation, like a stipend or salary, the tuition reduction itself may be excludable under qualified tuition reduction rules.
Okay, now let's hit some purely non-taxable items. Big one. Life insurance proceeds.
Generally, life insurance proceeds paid to a beneficiary due to the death of the insured are excluded from the beneficiary's gross income, a major benefit.
Any catches?
If the proceeds are paid out over time instead of a lump sum, any interest element included in the installment payments is taxable interest income. Also, there are special rules for accelerated death benefits paid to terminally or chronically ill individuals before death. These can often be excluded too.
Okay. Gifts and inheritances. If someone gives you money or property.
The value of property received as a gift or inheritance is excluded from your gross income. The gift giver might have gift tax implications, but the recipient generally doesn't have income tax.
But what if the inherited property then generates income? Like inherited rental property?
Ah, good point. The inheritance itself is tax-free, but any income generated from that inherited property after you receive it, like rent, dividends, interest, is taxable income to you.
Makes sense. What else is generally excluded?
Basic Medicare benefits are excluded. Workers' compensation benefits received for job-related personal injury or sickness are excluded. As we mentioned, damages received for personal physical injury or physical illness are excluded. And if you pay the premiums yourself for an accident insurance policy, then any benefits you receive from that policy are generally excluded from income.
Okay. Last one. Foreign earned income exclusion. For people working abroad.
Yes, this allows U.S. citizens or residents working abroad to exclude a significant amount of their foreign earned income from U.S. taxation. For 2023, the maximum exclusion was $120,000.
How do you qualify?
You have to meet certain requirements, either the bona fide residence test, you're a resident of a foreign country for an entire tax year, or the physical presence test, you're physically present in a foreign country or countries for at least 330 full days during any 12 consecutive month period. You also have to have your tax home in a foreign country.
Does the excluded income just disappear for tax purposes?
Not quite. While it's excluded from gross income, the excluded amount can still affect the tax rate applied to your other non-excluded income. It can push your other income into a higher tax bracket. It's called stacking.
Ah, so it still plays a role. Wow, that's a lot to consider. It's clear that income for tax purposes is far more nuanced and fascinating than we might initially think. It really stretches far beyond just your regular paycheck.
It absolutely does. So many different sources, rules, exceptions.
Well, we've journeyed through the intricate landscape of gross income, from the obvious stuff to the surprisingly subtle points. Our goal today was really to give you that shortcut, those aha moments, without you having to sift through mountains of dense tax code yourself.
And knowledge, especially in this area, truly empowers you. Understanding these definitions, these distinctions, really helps in making informed financial decisions day to day and, maybe more importantly, avoiding those unexpected tax surprises down the road. It helps you sort of anticipate what the tax authority sees, not just what you might perceive as income.
Yeah, absolutely. So here's a final thought for you, our listeners, to ponder. In a world where financial transactions are constantly evolving, think digital assets, the gig economy, new forms of compensation, how might future definitions of income need to adapt to remain fair and comprehensive? What does income from whatever source derived mean in the metaverse or with decentralized finance? Something to think about.
A very relevant question for the future.
Thank you so much for joining us on this deep dive. Until next time, keep learning.